Good morning, traders and investors. My name is 𝗧𝗶𝗺, and I'm the senior strategist for WealthPress. Today is Tuesday. It is July 20th, and we're going to open up in about, an hour and, let's see here, about an hour and 45 minutes or so. The market, as you can see here, is not random. It is bouncing higher, but it's not random because, as you can see here, the Dow is up more than 75, 80 points. Now, while this may be a reaction, it's a darn good reaction. It looks like we shook out the weak hands, and unless we test the lows today, I think we're going to be good for another few days. Again, I'm not 100% happy with momentum levels, but we had a pretty darn good shakeout yesterday. As far as news today, we've got housing starts and permits. I think the numbers will be on the level. Typically, housing starts are really, really strong in June, and I'm not expecting anything too negative. The bond market, I think we're going to cool off. I think we're going to fill this little gap right here, especially if stocks go back up. I don't think the bond market has a lot of upside left. I think most of what's left in it is a reversion back to the 50-day moving average. So there should be back. So we should be moving back down. Expect a down period today. In terms of the put to call ratio, this will answer the question of how bullish or bearish the market is. This is a pretty stretched out market to the downside, at least in the short term. So I do believe that today's bounce is going to be fairly meaningful. I don't think it's going to be a false breakout. It's going to be very important to see how the market trades towards the end of the day. For example, this is the SPY right here. If we cool off and if we lag lower and if we break this and start hitting the low again or taking out the low, it's not going to be a good sign. But if we stay above the 50-day moving average and we start moving higher, it'll be a pretty good sign because yesterday's shakeout was a pretty good shakeout, and we're at the 50-day line, and the markets typically bounce off the 50-day line, especially when the RSI is really, really low. And I'm using a 2-day RSI because it's a very quick RSI. It's a short-term momentum RSI, but it's telling us that we're going to be bouncing back up about 75% chance. Only for the next day or two, all right? Now, this is the number of stocks trading above the 50-day moving average. Any stock over, I think, $2 or $3, not the S&P, not the NASDAQ, all the stocks on the exchange. Looks like we're only 23% of stocks are trading above the 50-day moving average. So the stock market, the S&P should actually be a lot more bearish. It should look like this right now. This is the equal weighted SPY. And you could see here we're already in the twilight zone. But I think if we can go higher, we will fill this gap and start moving higher. This might have been a shakeout. And again, the reason why I say that is because we're at the 50-day moving average on the regular SPY. The momentum levels are starting to get pretty low. I think if we go down maybe to the 10th percentile, we maybe have another shakeout. But many times, if you look at a 20-year chart, we'll end right here, right where we're at right now. So this could be the bottom. Let's talk about global economy because that's big and that's what's driving this market. Alarms have been mounting in Japan. Oh boy, we've been all over this. With just 3 days to go before the Olympic Games, new COVID cases are being found among athletes and non-athletes with the games. Japanese government repeatedly promised safe and secure games, but just about 22% of the population is vaccinated. And the World Health Organization says cases and deaths are climbing globally after a period of decline spurred by a highly contagious Delta variant. Folks, I hate to say I told you so, but we've been all over this last week. Remember consumer staples, Delta variants, things picking up, fear coming back in. Even in the U.S., where the vaccination rates is higher than in many other countries, people in Los Angeles, one of the biggest economies in America, must once again wear masks indoor regardless of whether they're vaccinated following spikes in cases, hospitalizations, and deaths. Besides the new variant, other risks include fading pandemic relief efforts for the U.S. government and Federal Reserve that looks to begin paring back its assistance for market later this year. That, and it's time for that, which is why I think the bond market is going to drop. The week brings earnings. Forecasts profit growing nearly 70% from the second quarter. That's going to be the benchmark. And that will be the strongest quarter since 2009, where the economy began climbing again. Don't hold your breath. I'm not sure we're going to get there. As I mentioned a few minutes ago, the put to call ratio. This tells us yesterday that put buying was very rampant and market was in panic mode. And usually when put to call ratio gets near the 1 level, it tends to revert, just like it does when it gets to the 0.65 level. So this is a bearish, a market that's bearish, that's way bearish, that's turning around. Also, as I said, the percentage of stocks trading above the 50-day moving average is getting a little bit lower, at least in the short term. Now, if you look at the number of stocks in the S&P, let's take a look. This will give us a good indication. 34%, so it's 35%. So it is getting lower, but again, the S&P can drop a little bit more. If we have a major shakeout all the way up to here, the S&P will be taken to the 200-day moving average. But it doesn't look that way right now. It looks like we would have a few days of a bounce before that happens. Now, looking at the major sectors, real estate and healthcare are the major sectors, and there's a fragmentation between technology and consumer discretionary, which tells us the markets are fragmented right now. Whenever you see technology and consumer discretionary not next to each other, that's telling us the markets are fragmented. Then, if you look at it on a monthly basis, you'll see that technology and consumer discretionary are actually aligned. But we don't look at it on a monthly basis. We look at it on a cumulative basis. And on a cumulative basis, real estate and healthcare are right now the big factor. Now, real estate is interest rate related, but healthcare doesn't really jive too much with interest rates. This is more of a panic. So this is interest rates, and that's COVID right here. And that's the two sectors that are leading. And I wouldn't be surprised to see healthcare and real estate trade above tech and consumer discretionary over the next several days as we see some reprieve. But I am expecting the S&P to cool off and possibly trade higher, at least for a few days. It's going to be really important to watch the trading action today. For example, as I said, if towards the end of the day you start seeing us coming down and breaking this low, it's not good. If towards the end of the day you start seeing us making higher high and the bond market filling this gap, that is upside confirmation. So I want to give you guys all the cards on the table so you have a good idea of how to trade today's market action. Now, I've got 3 stocks. If we do have a little pullback, now these are short-term pullback trades. These are not long-term trades. And they go along with the current economy because remember, what happens when COVID hits? People get stuck at home playing with their Facebook, internet, and healthcare. So Facebook pulling back from a swing high. The RSI is grossly oversold. Look at this. It's at 2. The 2-day RSI is at 2. Again, we may be coming back up. It's very dependent on the S&P 500. But I like Facebook. And if it breaks the 50-day moving average, no soup. We're out. Next one, pharmaceuticals. I like pharmaceuticals right now, especially with COVID. That's when the market cap starts moving into pharma stocks. And that's what happened during COVID. They were really bullish. So I think we'll see a bounce back in Alexion Pharma. The 2-day RSI is at 6 now. I think we're going to bounce back a little bit. Again, these are short-term pullbacks. And if we break this low right here, get out. Short-term pullbacks. Next one, HIBIT, HIBB. Look at that, hitting the 50-day moving average after pulling there. And we are oversold right now. And if you look at a profile of the stock, retail, apparel, shopping goods, small caps, all right? People, shoes, apparel, smaller stocks, not large cap stocks. This stock's given us a 270% return. It's got a market cap of $1.3 billion, so it's not really going to be impacted too much by the S&P, at least for the next few sessions. Or the large caps, and it's outperforming the small caps, as you could see here by the Russell, which is all the way at the 200-day moving average, which is where the S&P should be. So I think we're bottoming out right here. I think we're going to see higher upside on the Russell. I think the NASDAQ 100. Let's look at the NASDAQ 100. I think the NASDAQ 100 is going to be coming back up, and I think and it's holding up really well right now because of this COVID tech. COVID loves tech because people start playing with their gadgets and staying indoors and relying on tech. So that's why you're seeing tech stay up a little bit. But I'm going to tell you right now, market momentum-wise, I'm going to tell you, it's all in the large cap. Look at this. I showed this to my guys yesterday. You got to see this. Look at the stocks trading above the 50-day moving average in the NASDAQ 100. 61%. Hold your breath. Are you ready for this? 61.76 versus NASDAQ Composite, 29%. So the NASDAQ as a whole is pretty cooked. But the NASDAQ 100 is showing very strong market cap. So again, as you could see here, the NASDAQ composite. What I'm trying to get at is that there's a huge concentration in a few large stocks that are pulling the market cap up, but the rest of the market, the Russell 2000, the S&P equal weighted, as you could see here, it's just not doing all that great. This is what the S&P really looks like right now when you take away the market cap. It's at the 200-day. It's in twilight zone between the 50 and the 200-day line. And here's what the Dow Jones looks like. Also below. So I am expecting a little bit of a pullback today. Keep your eye on the large caps. If they start breaking lower, if we start breaking down towards the end of the day, not a good sign. But if we start breaking up, there's a good chance we'll see a little bounce for the next few days. Now, I've got something really, really important for you. Folks, we're seeing another wave of COVID cases, and I told you we would. Stocks are vulnerable, and the Fed might change stimulus efforts this year. Disaster can strike at any time, like the dot-com bubble in 2008 financial crisis, and even last year's pandemic-induced flash crash. What do all these events have in common? Well, at least two things. First, most people love massive chunks of their portfolios during these events. They did. They lost a massive chunk of their portfolios during these events. Second, some people managed to navigate them and still come out on top, right? You have two choices. There's two ways to play this game. So some people lost a big chunk of their portfolio, and some people to manage to make a killing in this period. Legendary trader Chuck Hughes is one of the few to financially survive these tragic events. And by using his incredibly powerful trophy trade system, he hasn't had a single down year in 20 years. Chuck sees how market crashes can negatively impact a trader's portfolio, and he wants to help. But he's also seen how trophy trades can give investors a shot at thriving during good years and bad years. And we've got a lot of turbulence ahead of us, folks. All you've got to do is click on the link below to find out more about Chuck's strategy and how you can use it in the next market downturn, which may be sooner than later. Chuck is a 10-time heavyweight trading champion, and he's going to help you navigate the market the right way. Make sure to like this video. Click on this link below. Learn more about Chuck. Do it now in trophy trades. And make sure to like this video. Subscribe to this channel if you're watching on YouTube. Stay ahead of the market by being the first to be notified when I post my next video. And have an amazing Tuesday. Bye, everyone. Be careful out there. We're in danger zone right now.